Is it? Okay, good. My controls for it are not here, so I'm not sure why that's there. So, okay, let's just jump into rates right now. I want to show you guys kind of what's happening with the history of mortgage rates for a little while, because a lot of people are saying, oh my gosh, interest rates are so high. We're in this space that is just unsustainable with interest rates being so high. I want to just do a quick reminder of really where we're at, because if we really look at this, rates aren't really that as high as they we were in a let's just say a fire sale or an extreme clearance sale in the last couple of years. So if you look at what the rates were just in December of 2019, it wasn't that long ago where we were at the same rates. And if you look, I mean, this is 3 years ago, basically 3 years ago, we were at 4.8. Now, if you look at the volume of actual real estate that was going on back here, it was quite high. So we have to put this into perspective. Yes, rates are right now, if you look at this breakdown on the Mortgage News Daily, where rates are at right now, we're above 4% for the first time in a long time. So that's never a good thing. When people are, there we go. When people are used to seeing rates in the 2s and 3s, psychologically, it's a barrier. So we need to remind people that for the last 2 years, we have been in a clearance sale for mortgage rates. And the sale's over. The after Christmas sale over, Red Friday or whatever, Black Friday, whatever that is over. We are now in a normal interest rate environment right now, and we're pushing towards a little bit higher in interest rates. So people need to understand right now that if you're on the sidelines, if you wait, you're going to be in a bad position, because we will continue to see appreciation go up. We will continue to see rates go up as well. So if you look at the economic calendar, that's what's happening this week, I want to kind of show you what the big movers are going to be. This Wednesday is going to be what's called the Fed minutes. So down here, when the Feds release their minutes, it's basically a breakdown of what is happening inflationary with kind of what their tools they'll be using to offset this inflation. And I've been telling you guys that the scary thing about what's going to cause interest rates to go up is the running off of the Fed's balance sheet. So I want all of you to be very cognizant of what that means and listen to what the news is saying about it, because that's the one thing that is going to be, I think, the scary piece to seeing rates increase very quickly. And basically what that is when the Feds sell those mortgage-backed securities that they've been buying, they're going to flood the market with those, make bonds less valuable, which makes the rates go up. So the running off of the Fed's balance sheet, the selling of those mortgage-backed securities is going to be the tough piece that we really need to watch. That's going to cause interest rates to go higher, and with inflation. So March is probably going to be the worst month that we'll see the peak of the inflation schedule. So as I've talked in the past, 12 months ago, the inflation number was rather low. We are going to replace that low number with a higher number and get a new average. So that's going to cause the inflation numbers to spike to be at their peak in March. So I think March is going to see, we're going to see a little bit rough. It's going to be a rough go, so to speak, until March. And then we may see a little bit of reprieve after that. But we have to be careful with what the Feds are doing, because when the Feds say they're going to be running off their balance sheet, that could be a bad day. So let's look at what happened this last Friday. This was Friday. This was what I call a bad day for mortgage bonds. Very rarely do you see a drop in mortgage bonds like this. So it was a bipolar day. We opened the day down 117 basis points. And then we had news of potential going to war, the Ukraine and Russia going to war. And then we saw a huge rebound. So we went from negative 117 basis points to positive 50 basis points within 3 hours. So it was what I call a bipolar day. If anyone in the industry could have their hands on Xanax, that would be the day that we all needed it, because we were all over the place. There was 4 or 5 rate changes in one day. It was unbelievable. So this was a bad day. And then this was the rebound, so to speak. And then we had today, which we bounced back down below, right up against that Fibonacci level. So if we pierce below this, it's going to be continue free fall. I mean, look at this. This is a pretty dramatic line downward from where we were just in November of this last year. So we've lost 104. We've lost 450 basis points in pricing. So a rate back then now costs 4.5 points to get. So that's the difference. One of the most important things we need to focus on right now, I know all of you have buyers that are fatigued, buyers that are questioning what the rates are doing. They might not even know what rates are at right now. We need to make sure we're reaching out to everybody to let them know the difference in what a rate of 3.5 and 4.125, or even 3 and 4.125 has. So I want to illustrate that real fast in a quick little breakdown. So if you have a 450 loan amount at 4.125, that's a payment of $21.81. If they got pre-qualified at 3.25,
they're done.
3.25, that's $19.58. The difference, 1958 to 4.125, 1958, that's $250 basically, $270 in difference. So for a lot of people that are in that 350 to 450 category, that's a car payment, or a small, that's a big chunk. So that really could hurt their ability to purchase. So let's look at that. So this was, let's look at 3.25. That's 1958. What price point does that now put them at? So we need to go in with today's at the loan amount of 450 at 4.125. They would have to lower their loan amount by $50,000 to keep this payment the same. So we basically have lost $50,000 worth of buying power in this rate bump. Now for the luxury buyer, this probably isn't a big deal. It does sting a little bit, but for the first time home buyer, it's a big deal. So we need to make sure we're educating our borrowers that are out there as far as where rates are, how that could impact their approval, and kind of reevaluate where they're at. It is a hard pill to swallow for a lot. A lot of people are saying, well, now I can't buy, so I need to wait. But waiting is even worse, because if rates continue to go up, we're going to continue to see that scale slide in a way that's not advantageous to our first-time home buyers. So now what? What do we do? I think the most important thing we do now is re-educate our buyers and our sellers. For those that are selling homes to buy anew, they may change their tune, so to speak, on what they want to do. So when we're looking at interest rates going, maybe they hit 5%. It's hard to say. I think we'll go into the low 4s. I've kind of talked about that for a while, and then maybe come back down. I want to show you a little bit of a breakdown of the Treasury yield spread, because this is a piece of the puzzle that a lot of people don't talk about. This is the 2-year versus the 10-year, and this is a predictor of a recession. So a recessionary period would bring lower interest rates for the long term for mortgages. So let's look at this real fast. This down here is when the yield curve was 0, when you compare the 10-year and the 2-year. When it's 0, when it goes below that, that is a recession. This was a recession. This was a recession, small one here. We tapped on it right here, and now we're heading down. We're about 40 basis points today away from having a 0 yield curve. So this is going to be interesting to watch. So if anyone says that there's a 0, the yield curve is flattening, that's what they're talking about right here. So if this does in fact happen, we may see rates kind of pause and stabilize a little bit on the mortgage rate. So I'm going to be watching that really carefully to kind of know what is happening with those interest rates. Now, if anyone has buyers that are under contract with a builder and they're 6 months out, 3 months out, they need to have a conversation, because their lender at the builder, wherever they're at, probably isn't talking to them and giving them rate updates. So I urge you, if you have anyone that's in the process of building a home with a builder, you have a conversation with them to have them get an update on the rate to see what their payments are, because I have a feeling that there's a lot of people that are going to be taken by surprise, especially with the timelines it's taking to build these homes. So keep in mind, guys, we're at 4.05. Most likely when they went under contract, they were at 3%. That's a big chunk, big difference. All right, so we have some questions here. I'm going to remove the shared screen real fast. And go back here. So interest rates, 4%. It's been a while, but it hasn't been as long as we might think. November of 2019, December, we were at the same spot. So it wasn't that long ago. So do you guys have any questions of what's happening with interest rates, or what the terms I've been using are? The balance sheet runoff, I think, is the thing to really watch. The yield curve flattening, we really need to watch as well. That'll kind of tell us when rates will stabilize. But with the unknown out there in regards to the Feds running off their balance sheet is really what I'm watching. That's going to be the piece that's the I don't know what do you call it, but the scary piece. But the rates are still good historically. We just have to get into the psychological mental space, mental capacity of that this last couple of years was an anomaly. And now we're back into normal interest rates, because 4% was a great rate 2 years ago, 2.5, 3 years ago. So what do we do moving forward? We have to re-educate our buyers. Every single one of them you're working with we have to recalculate kind of where they're at, what they qualify for, make sure that the price range that they're in is still comfortable for them, because a lot of people may be approved for it, but they may not be comfortable with those payments. So I know it's a hard pill to swallow when rates go up. I do believe they're probably going to continue to go up. And if you look at that trend line that we were looking at just a few minutes ago, you can kind of see where we're heading. So now the Feds will be raising it by 50 basis points. They said 100 basis points between now and July. There are only 3 times between them that they can raise. So that would mean there are 50 basis points, 25 and 25. So I believe when the Feds come out, it's either going to be 25 or 50, but most of the people now are swinging towards a 50 basis points on the Fed funds rate. Now that Fed funds rate, that's the rate at which the banks can borrow money overnight. It's not long-term interest rates. So 2 things we need to watch for. I hate saying this, but the best thing that we can do for mortgage rates is bad news. So if there's a war that breaks out on Wednesday, like they say that may happen, I don't think it will. I think we're playing a game of, it's like the game of Risk. I think there's just a lot. It's like a chess game right now between Ukraine and Russia. I don't think that actually happened. Hopefully it doesn't, but that could make rates come back down a little bit, and we could see a little bit of rebound for the better. Any bad news in the markets usually is good for mortgage rates. So watch what's happening in the Ukraine. That could give us a little bit of relief on mortgage rates. And then watch what the Feds do, because when the Feds raise the interest rate for the first time, it may help in mortgage rates come back down a little bit. But the running off of the balance sheet could make them come back up. So keep in mind, if the Feds act strong with 50 basis points, the stock market's not going to like it, but the bond market will, because inflation is the enemy of long-term interest rates. So when they raise the rates, we may see a little bit of ugliness in the stock market, but we'll probably see rates on the mortgage side come down a little bit. But what will counteract that is the Feds running their balance sheet off. And that's really the unknown. That's what I'm really watching to see how much they're going to sell off, the volume and the timing of that. So rates are at 4%. Call all your buyers, make sure they understand if they're working with a different lender, where rates are at, and get out there and try to sell those 4,000 homes or whatever that we have on the market. It's very competitive. So keep in mind, when it's competitive like this, I know you guys know this, but making sure you have the strongest offer, getting your borrowers, make sure they're fully approved your underwriting, it helps tremendously. Even if they're not ready, you know that once they start looking at homes, they probably will find something that they're going to want to make an offer on. It's just the way it works. So if they're looking, make sure we have that loan fully approved through underwriting. Any questions for me today?
Sean, can you pull up the rates that you had there off of what it is as of today for 30, 15?
Let me share my screen again real fast. Hold on 1 second. And screen one. So here is the, can you guys see this? Mike, can you see this?
Yes.
Okay, so 30-year 4.05 rate costs 0.40 points, and that's the national average. This is not our rates. Remember, rates are very specific to individual buyers. Credit score has a massive impact on interest rate. So this is just an average based on very specific scenarios. 15-year, we're still at 3.31. FHA, you can see is a little bit better. We're at 3.75. Jumbo, look at that. Jumbo's still in the 3.55. Jumbo's private money, so these moves don't affect them as much, and they're slower to move. And then arms, look at that. The 5-1 arm is 3.71. There's only a quarter difference or so, 30 basis points in difference, 35 maybe, on a 30-year versus a 5-year. And that's that yield curve flattening that we're talking about.
And once that yield curve goes down below zero, it's the signs of a recession again, or indicates towards that, is what you were saying?
That is exactly right. Yeah. And a recession's not a bad thing.
It's a corrective recession from what's been going on.
Yeah, real estate's not a recession isn't a bad thing for real estate, but it's a bad thing for the economy. Anytime during a recession, there's going to be a shuffling of people because there might be jobs lost. But we have such a strong demand for employment right now. From the employer's side, there's more job openings now, percentage-wise per capita, than there's ever been. It's just people don't want those jobs. So it's an interesting economy that we're in right now. So we just need to watch it closely. Listen to what when the Feds release their minutes on Wednesday, it's going to be really interesting. We may have a pretty volatile day on Wednesday. But if you guys need anything, keep in mind we have a lot of tools to help you with your buyers. Rates will continue to increase, I believe, and we'll have a little bit of reprieve. But with the Feds running off on their balance sheet, there's some people think that they can get into the 5s. So we're at 4 now. So if we hit 5, that's another $50,000 in buying power that somebody could potentially lose. So keep that in mind. If you have any buyers that are on the fence, they should buy the home based on what they believe the price of that home and the need of that home, not on the interest rate, because you could always refinance. There's going to always be opportunities to refinance, whether it's removing MI after appreciation or if there's a dip, but you can't always buy at a price that we have right now. Yes, prices are higher than they used to be, but the markets are equalizing across the country because people can work remotely now. So that's really caused our markets to really go upwards, where others are just aren't increasing as much. I mean, if you look at the prices of California versus the prices of here in some areas, we're coming up on that. And it's because you no longer have to live downtown in LA or in Silicon Valley to have an IT job. You can move elsewhere. So the demands aren't as high for those areas. They're moving elsewhere. So be strong out there, keep positive, and enjoy this Valentine's Day. Oh, by the way, this is the 24th anniversary of my wife and I's first date. So I'm going to have,
Sean,
yes.
I'm sorry to interrupt that. I just wanted to catch you before you left. I just had a couple questions that one of my buyers just brought to, because she's panicking, of course.
Yeah.
But she said, how does a person qualify for an FHA loan?
So an FHA loan is actually the easiest loan to qualify for. There's different rules and requirements for FHA versus conventional. FHA has a lot lower limits on what you can borrow compared to a conventional loan. Conventionals in the 6s, FHA's in the 4s, like 446, 250. So the way that FHA is advantageous is it allows for lower credit scores to enter into the housing market. If you have a 550 credit score, you can get an FHA approval if all of the rest of the risk assessment is good enough.
Well, she actually has an 840 credit score.
So the one thing that's nice about FHA is it's easier to qualify on the debt to income ratios. A conventional will only let you go up to about 50% debt to income ratio. FHA allows 55. So you may be able to qualify for a little bit more with an FHA loan compared to a conventional loan based on debt to income ratios. Keep in mind, FHA is an expensive loan. You have an upfront mortgage insurance premium that's rolled into the loan of 1.75% of the loan amount. Plus you have more monthly mortgage insurance. And FHA mortgage insurance is permanent. It doesn't fall off automatically 7 to 8 years down the road. The only way to remove it is to refinance. So there's some positives to FHA because it's easier to qualify for more, but there also are some negatives as well. Typically, a really good borrower with really high credit scores would go towards the conventional loan because the mortgage insurance is cheaper if you have a really high credit score and you avoid that mortgage insurance premium. So FHA, I would say if somebody had a 780 or higher credit score, the only reason I would put them into an FHA loan is if their debt to income ratios were quite high. Usually with a credit score that high, conventional is a better loan.
Okay. And interest rates are the same all the way across the board, like mobile homes, regular homes, all those, it's all the same.
Mobile homes are much different. There's very specific rules with mobile homes. If a mobile home is built prior to June of 1976, there's no financing available for it in either VA, FHA, or conventional. Mobile homes have higher interest rates. Also, condos are goofy with FHA. They're very difficult to find an FHA approved condo. Condos are just kind of a mess all the way around, just because you have to go through a separate approval process for them. Outside of the buyer, you have to get the condo approved, and a lot of condos aren't approvable based on their budgets, based on the occupancy ratios, etc. But the different properties do have different rules, and different mortgage types have different rules for different properties. So it's hard to manage all of that. That's why people new to the mortgage industry have a tough time, because there's a lot of rules. There's a lot of regulations. It's almost like being a lawyer with all the different rules that are associated with all these different mortgages. You have to be able to navigate those. So when somebody gives an FHA approval and they're looking at condos, it's extremely difficult to get them into a condo.
You know,
Single family home.
what we found out this last week is she did put an offer on a condo and wanted just to put 5% down, and the HOA is requiring it to be 10% down because of the new Freddie Mac and Fannie Mae guidelines due to the collapse of the condo in Florida. So now the HOAs have to have a reserve, a certain amount of reserve. And so now they're requiring all homeowners to put down at least 10%. Do you know anything about that?
That might be specific to that project.
Oh, okay.
The budget, the budget is one piece. You have to allocate a specific, it's 10% of your annual budget has to be put into reserves. And if it's not put into reserves, if you're below that budget, then you have to do what's called a limited condo review. A limited condo review is available if you put 10% down. So there might be a little bit more to the story behind the 10% down requirement for that specific condo. And there might be something else there. But yeah, the budget is a very important piece of it. And maybe we could talk a little bit more on that. Can you tell me about VA loans? Have a client right now and they need a lower down payment, something better than VA. VA is the best loan possible because 0 down is required and there's no limit on loan amount. And I'm sorry, Frankie, did I answer your questions?
Me?
Yeah, did I answer all your questions that you had?
Yes, thank you.
Okay. And if you have any further questions, let me know. But yeah, VA loans are the best loan for low down payment if it's about eligible. The only problem with VA loans is it's only for a primary home. So if somebody wants to buy a secondary home or a vacation home, you can't use a VA loan for that. It's a great loan. It's my favorite loan. It's the easiest loan to qualify for. Debt to income ratios aren't even a part of the approval process. It's all based on what's called residual income. How much money per month does that VA have, that veteran have after paying their bills? If they have a specific amount that's over a dollar amount of, maybe it's between $675 and like $1,200. Then they qualify. So they could have a debt to income ratio of 70 and still qualify for a VA loan. So it's the easiest loan to qualify for. It's the loan with the least amount of money out of pocket. By far the best loan for low down payment.
Sean, I missed one sentence. Did you say it can only be used for primary? Is that what I heard you say?
That's exactly.
Perfect. Thank you.
You got it. Any other just random questions? Do you have any specific scenarios you're in that you need a little bit of coaching on?
Yeah, I do.
Okay.
I have a question. I just want to clarify. I have friends who purchased a property. It's a manufactured home, but it's been moved. So this is a second location. We know that's a problem. And as far as I know, it can only go cash or VA. Is that correct? If they were to sell it?
Yeah, VA does allow them to be moved. FHA, Fannie and Freddie, if a manufactured home has been moved, you are no longer eligible. So when you do move a property, you do need an engineer's cert done to ensure that the structure itself is still strong and intact and up to standard, so to speak. But yes, cash or VA is the only option. And a lot of lenders have overlays that if it has been moved, they don't want to touch it. So make sure you have a lender like this guy right here that has no overlays on that.
And what about conventional? No?
Nope. If it's moved,
Okay.
that's a kiss of death. Yeah. It's
Thank
really frustrating because a lot of people don't know that. So they move it unknowing that they just like push themselves out of a lot of loan options for selling. Great question. Any other questions today? So rates are at 4%. Basically, if you had someone pre-qualified 6 months ago, they've lost about $50,000 in purchasing power. It's about $250 more a month for the average person. It is a hard pill to swallow, but anytime you compare with what prices were and what things cost when you have a major sale, you're going to be disappointed. So we are kind of back to normal. If people say I can't buy because rates are too high right now, let them know that, well, it was on sale and now the sale's done. Now we're back to normal market with rates. And it's a psychological game, but the sale's over. Now we're back to normal. And let's just keep our fingers crossed, say a little prayer that we have lower interest rates as we go through and that it doesn't get kind of out of control with the Fed selling off their balance sheet. So I'm going to stay on for a little bit longer. If you guys have any questions, let me know. And if you have any ideas for things that you want to learn more about in this market, shoot them my way. Send me a quick text and email, and I'd be happy to put together some information for you on that. Don't forget about our bid over ask presentations, our rent versus buy presentations, and the cost of waiting presentations that we have that are customized for you, for your customers.
Thanks, Sean. Appreciate it.
Yep, you got it.
Thank you.
You're very welcome. Have a wonderful day. Happy Valentine's Day and happy Manic Monday. All right, guys, if there's no further questions, I'm gonna go ahead and sign out. Have a great week and we'll talk to you guys soon.